Goldman Sachs has just dropped a major warning about an upcoming correction. And it's not just them. Ray Dalio, who's literally one of the biggest and most respected hedge fund managers in the entire world, recently said, and I quote, "The picture is pretty clear. We are in the territory of a bubble." Now think about where we are right now. Despite some of the pullbacks we saw in November, the stock market is trading just a hair below its most recent all-time high in terms of pure price. AI stocks are absolutely booming, and it feels like everyone, and I mean everyone from your cousin to your barista, feels rich. But here's the fundamental problem with that picture. When stock prices skyrocket this fast and get this far disconnected from their underlying value, smart investors like you, start to get rightfully nervous. Now, before you even think about hitting the panic button, panicking is the worst thing you can do, and it will accomplish nothing. In this video, I'm going to break down exactly what that warning from Wall Street means, show you how to spot the telltale signs of a bubble, and most importantly, explain how you, even if you're a complete beginner, can protect your hard-earned money while still positioning it to grow. And here's a little hint for you. It has everything to do with what's up here in your head. You're not going to hear me say sell everything or run to cash like so many other fearmongers out there. That's not what smart strategic investing is about. What you are about to hear from me will be different from the typical noise. And we're going to approach it all through the powerful lens of principle-driven investing. Now take a look at the article behind me. This is from Goldman Sachs, and I'm going to share some key portions of this article from CNBC with you. Here's what the very first paragraph says. Global markets may be due for a reality check after this year's relentless rally, warned two of the biggest names on Wall Street. Those two names, none other than Goldman Sachs and Morgan Stanley, who cautioned investors to brace themselves for a drawdown over the next couple of years. In fact, the CEO of Goldman, David Solomon, who was speaking at the Global Financial Leaders Investment Summit in Hong Kong, said it's likely there will be a 10 to 20% drawdown in equity markets sometime in the next 12. He also added a crucial insight, saying things run and they pull back, so can reassess. And as for the Morgan Stanley CEO, he went a step further, saying we should actually welcome corrections like this. Their warnings came during a discussion about how major institutions like the International Monetary Fund, Fed Chairman Powell, and even the head of the Bank of England have all raised serious concerns that stock prices might be getting a little too high for comfort. In other words, this isn't some isolated opinion. It's a powerful message that's echoing from multiple corners of the financial world. But before we dive any deeper, I need to make a critical point here. Notice that nothing that has been said so far has been based on value. Not a single word. So let's break down what they're really talking about. They're basically just saying, hey, the price has run up a lot. And you know what? That part is absolutely true. The NASDAQ is up almost 50% since its low point in April. But guys, listen to me carefully. Price alone tells you absolutely nothing. It's the price relative to value that matters. We will preach this gospel until we are blue in the face, until YouTube itself simmers away into whatever the future holds for it. It is never, ever just about price. It is always about a relationship between price and value. So if you happen to be new to our channel or just new to investing in general, let me first take a moment to quickly explain what a market correction actually is. A correction is technically defined as a period when the market drops between 10% and 20% from a recent price high. These can be short-lived, lasting a few days, or they can drag on for a few weeks or even a few months. They're usually triggered by some piece of big news like major economic changes, the shock of rising interest rates, unsettling global events, or sometimes just plain old fear. But here's the most important thing you need to understand. Corrections are a totally normal, healthy part of the market cycle. And please, don't confuse a correction with a crash. A crash is when the market drops incredibly hard and fast. It's also not the same thing as a bear market, which is characterized by deeper and longer drops of 20% or more that usually last for many, many months. I think the average one is around a year long. Now here's the good news in all of this. Markets have a proven history of bouncing back after a correction. In fact, if you're a long-term investor with a solid plan, these dips can actually be phenomenal opportunities, chances to buy strong, wonderful companies at much better, more attractive prices. I'm going to be honest with you guys. I absolutely love it when the market goes down. But I want to remind everybody of a crucial mantra. Just because something is becoming cheaper does not automatically make it cheap. We are always looking at price versus value. Yes, a 10 to 20% pullback makes perfect sense after the market just had a nearly 50% run up in a very short period of time. At the end of the day, if I have stocks that I've recently purchased, which I do, I currently have 28 stocks in my personal portfolio. And if more of those stocks get cheaper relative to what they're actually worth, you better believe I will continue to buy more. Now, do I personally think there's something more significant than a 10 to 20% drop coming at some point in the next few years? Yes, I absolutely do. But here's the thing, it still doesn't change the core advice I give on this channel. I teach here because I want to empower people with a simple truth. Fear is not a strategy, and it's not going to work. Having a plan, that's what works. You people become fearful when they don't understand what is going to happen, or more importantly, why it's happening. When you finally grasp the underlying reasons why things happen in the market, you will be able to act smarter and more decisively when they do. The person who understands that while things are going well right now, valuation and price are dangerously disconnected with price soaring way higher than intrinsic value, that is a person who will thrive. And that crucial point, price versus value, is the one thing that these supposedly brilliant CEOs are not talking about. They're only following the price. This is why I love what Ray Dalio says here. He says, don't sell just because there's a bubble. He points out that if you look at the correlations, when you're in this kind of territory, the returns over the next 10 years are very, very low. We've talked about this 1,000 times. As given where we are in valuations today, the next decade is going to be difficult for investors. We've said this many, many times, but that's not the main point. The point is that we don't know exactly when things might turn. The fair value of the S&P 500 keeps going up as the GDP goes up. So think about this. Even if the stock market fell tomorrow by a hypothetical 50%, as long as the GDP gets better over time, as long as the earnings of the companies in the S&P 500 have a long-term upward trend, you can buy great companies at great prices. You should continue to dollar cost average because your job is to buy consistently at all times. We've shown this chart before, the one with the long-term value of the S&P as a line and the price of the S&P zigzagging around it. Your job is simply to buy all along the way. And you know, many other YouTubers steal this concept from me. Over time, you're going to overpay sometimes, and you're going to underpay other times. But over a long enough period, you're going to match the market's return. And you might be sitting there thinking, but I don't want to just match the market. I want to do better. And you absolutely can. But understand this, just matching the market will allow you to crush almost everyone around you because everybody else sells at the absolute worst time and buys at the absolute worst time. That's why you're here. That's why I teach on YouTube. I want to prepare you so that when we're way down here in a downturn and all your friends are scared out of their minds, you can sit there calmly and go, but stocks are on sale. I want to buy these, and you continue to buy. You load up on individual stocks while they're low because you're going to be the smartest, most prepared person in the room. While Dalio sees a bubble forming, he also said there would need to be something to pop it. The billionaire investor suggested it's unlikely to be tighter monetary policy, but it could potentially come from something like higher wealth taxes. Now, here's where I have to say I don't completely agree with that statement. He said there would need to be something to pop it. But if you look back at the dot-com bubble, it just ended in March of 2000. Nothing specific happened. There was no single event or catalyst that occurred that made everyone sell. It just reached a point where there weren't enough new buyers to keep pushing prices up, so stocks started to fall, and that was that. Now, there was an 8-minute video linked inside the article, and in it, Dalio says the picture is pretty clear. We are in the territory of a bubble, but we don't have the pricking of the bubble yet. His main point is that it's not just the price of stocks that matters in a bubble. It's also about who owns them. Are they held by strong hands or weak hands? Strong hands are investors who can stomach the volatility and hold on through the ups and downs. These are the people who have strong stomach, who can see a stock falling and rationally say, this is what's supposed to happen, and this is an opportunity for me. Weak hands, on the other hand, are usually retail investors, folks who tend to panic and sell fast the moment things get shaky. Dalio says if the strong hands keep holding, the bubble might not pop. But if too many weak hands start to sell all at once, that's when the whole thing can unravel. And guys, let me tell you, it will eventually happen. There will eventually come a point when the weak hands start to sell. Because if you don't have enough new buyers for these overhyped stocks, they're going to start trading sideways for a while. And when they go sideways for a while and those weak hands aren't getting the crazy returns they were promised, what are they going to do? They're going to sell and go find the next shiny object to invest in. And when they sell off their old stuff, what happens to the price? Just look at Amazon after COVID. You couldn't find anyone in the world who would say that Amazon was not a great business. But look at this 10-year. Amazon is up a lot right now, but this period right after COVID, up until literally that point right there in April of 2023 from August of 20, that was nearly 3 years of no growth. Why? People had already gotten their big gain. And guess what? The funny part is Amazon made far more money and had far more revenue during that flat period than during its initial run-up. This proves the point. It is entirely possible for a company to be overvalued. Now, here's the part that really stood out to me with Dalio's commentary. He's been telling people to sell, and I get it. He runs the world's biggest hedge fund, so there's a certain bias in there that we should at least be aware of. He said that what actually pops a bubble isn't the bubble itself, it's the prick that hits it. And as I mentioned before, I don't necessarily agree with that. I firmly believe that crashes, corrections, and bear markets can happen simply because of exhaustion. When people or companies need money fast, they're going to start selling their investments. And that selling pressure is what can bring the market crashing down. So what could cause people to want to sell their stuff fast? What if we have a recession? Or what if people aren't getting the returns they want from one asset and decide to chase another? Or what if Bitcoin falls and all the people who borrowed against their crypto holdings get margin called? The truth is, we don't know what the trigger could be. But the point is, guys, I don't want you to be the person who is forced to sell, because when you're forced to sell, you are not going to make good money. But when you have the opportunity to buy from people who are being forced to sell, that's when you're going to make a lot. So let's really break down what a stock market bubble actually is. A bubble happens when stock prices go up way too fast and way too high, primarily because people get caught up in pure hype and excitement. The price becomes completely detached from the company's fundamentals. Everyone starts buying simply because prices are going up. They have FOMO, fear of missing out. Their neighbors bought it, and everything seems to be going to the moon. Think about things like Bitcoin, or all those hyped up EV companies from a few years back, or the cannabis stock craze. There are often no real fundamentals behind them. It usually starts with a great story like a revolutionary new technology or a new cultural trend, and people start believing that in some way, shape, or form, this time is different. Hey, remember Beanie Babies back in the day? Remember the tulip bulb mania 400 years ago? I remember all the speculation, oh, but Bitcoin's different, it's a technology, we use it everywhere. Okay, sounds good. So what could prick the bubble? Honestly, it could be 1,000 different things, and I have no idea what it might be. The bottom line is anything can cause the bubble to pop, or absolutely nothing can. Sometimes it's just that people get exhausted. Now here's where it gets even more interesting. In that same video, Ray Dalio shares a big concern he has about stock market returns over the next 10 years. The reason this is so fascinating is that it's something we talk about in pretty much every single valuation video we make on both of our channels. He says we might be entering a long-term period where returns are much, much lower than what investors have gotten used to. If he's right, that means the days of easy money of seeing 15 or 20% returns every single year could be behind us for a while, and that's exactly what we're going to talk about next. Now, guys, this chart you see here is my version of the stock market to GDP ratio, a metric made famous by Warren Buffett himself. He calls it the single best indicator at any given moment on stock market valuations. According to this indicator, we are currently 120% overvalued, not 120% of value, but 120% overvalue, with the fair value of the S&P 500 sitting around 2. As you can tell, looking back over the last few years, that fair value line keeps going up, which makes perfect sense. As the US economy gets bigger, what should happen to the companies that operate within that economy? They should grow right along with it. So this logic is perfectly sound. Now, here's the scary part. This data goes back 100 years. The average return over a 10-year period without dividends is 6.4%. But watch what happens when we factor in valuation. When we have undervaluation of 30%, or better. So when the market is 30, 40, or 50% undervalued, the average 10-year return jumps to 10.7%. And as you get to more normal valuations and then into overvaluation, look what happens to the return. That 10.7% becomes 9, then it drops to 2, then it becomes a negative 1.1, then negative 2, and finally negative 2.4%. And that negative 2.4% is for every period where the market was 50% or more overvalued. I repeat, we are currently on 19% over. For those of you who understand math, the correlation here is a negative 0.82. That is a very, very strong inverse correlation. What that means in simple terms is this: as overvaluation goes up, future returns go down. As undervaluation gets better, future returns go up. And every single time you go into the past, before this most recent bull market, and look at overvaluation versus undervaluation, guess what happens? The exact thing you'd expect to happen. When you buy cheap, your future returns are good. When you buy expensive, your future returns are bad. But in the moment, when everything is euphoric, it is so hard to think that way. We're sitting here today, and it feels like stocks just go up every single freaking day. Yeah, the market was down a little last week, but no big deal. We have a new generation of people who have never experienced a long-term grinding bear market. Hope is not a plan. I used to buy stocks hoping that they would go up, but hope doesn't protect you when the market inevitably turns. Hope doesn't help you sleep better at night. Hope doesn't decrease your fear. I had to learn the hard way how to build a real strategy, one that makes sure that I personally never go to zero. Now, every single investment I make is based on numbers, not on hype. This is the very reason I built Everything Money. It was originally built just for me. I wanted the tools that gave me clarity, that took the fear out of investing, and that helped me make better decisions so I could sleep better at night. Then people saw me using them on YouTube and said, "Paul, can you give us that software?" I had to say, well, I can't because it's mine right now, but I can create it for you. And so I did, and a real community was born from that. Real people sharing ideas, live chats, live streams, and a suite of tools that help you beat 99%. I still use these tools like the stock analyzer every single day. Stop guessing and start learning. Click the link below, try our trial. It's just $7 for 7 days. And see for yourself how confidence can replace your fear. Now, guys, this is from Goldman Sachs. The headline reads, "Watch these 5 warnings from the dot-com bubble to know if the AI craze is peaking." And I've said for a long time now, this current environment reminds me a lot of the dot-com bubble. I first got into investing in the mid-90s. I rode that dot-com wave all the way up, and I thought I was a genius. I mean, my stocks went up 98.6% in 1 year. I was an absolute genius until it all came crashing down. The first warning sign they list is a peak in investment spending, a broad-based investment boom. So this is the year 2000, the dot-com era, boom to bust. Now, I will say when the stocks started to fall, that's when investments started to fall. So it's kind of a lagging indicator. I don't know if I necessarily agree with this one as a predictive tool. Look how this is here and this is here. I don't know. You can't really, I mean, maybe this started it and then it became a perpetual feedback loop into that. That's probably some kind of self-fulfilling prophecy. And guys, in fact, I see recently that Meta is spending a lot and people are still spending a lot of money on capital expenditures. So we might not be at that peak yet. The truth is we don't know, and anybody who says they do is completely guessing. Let's look at number 2, corporate profits start to fall. Well, of course, that makes perfect sense. In 1997, middle of 97, profits started to fall. Now, as a percent of GDP, it went from 10.5 down to 7.25, then back up to 8. It started around 8.25, 8.33. So it's not like these are huge, dramatic numbers. This chart makes it look a lot more exaggerated than it actually was. But still, the principle holds. Falling corporate profits would be something to cause concern. But I want you to stay with our channel for the long run. Why? Because when corporate profits do start to fall, we'll be here to sit there and say, yeah, but what's the normal corporate profit level? What should it be? Don't buy based on the peak. and don't sell based on the trough. There's a more normal level of corporate profits you have to understand. Number three, corporate debt rose sharply from late 90s. Now, I will say that the corporate debt sediment now is kind of different. Yes, I know some companies are raising debt, but interest rates have also gone a lot higher. Back in the late 90s, we were still in a continuous fall of interest rates that started in the early 80s. Now, number four, which I don't think they actually label as number four here, is when the Fed cuts rates. Guys, we've said this 1,000 times. Why does the Fed cut interest rates? They don't cut rates in a booming economy. That would be inflationary, and it doesn't make any sense. You cut rates when things are not doing well. They're starting to talk about cutting rates now. Or are we going to look back on this period and say, oh, things were actually slowing down? Because you still hear about a 20% increase in foreclosures year over year. You have credit card debt levels that are insane, and credit card delinquencies are going crazy. You see people pulling back on their spending at places like Target and Home Depot, but they're spending more at Walmart and places like that trying to save money. And the fifth one, credit spreads widened. Here's what this means, guys. When things are really good, bankers are okay saying we don't have to charge as much of a premium over the base interest rates because you're probably going to pay it back. When they start to tighten that spread, it's because they're starting to get a little apprehensive about the future. When they tighten their lending, that means they increase the credit spreads, which makes it more expensive for you to borrow money. So for example, if the 10-year treasury is at 4%, your bank might say to you, hey, if you want to borrow money for 10 years, we're going to charge you the 10-year treasury rate plus 2%. But if they were really worried about the economy and what was going to happen, they might say, you know what, we need to charge you 3% extra. They're going to increase that spread they charge. That's what this means. The spread goes higher when banks get more apprehensive the real estate bubble burst, because banks suddenly got tight with their lending when they realized they didn't have the right kind of loans out there. Now, all of these points that Morgan Stanley and Goldman Sachs brought up, they all said this. And honestly, I don't care. To be honest, the funny part is they haven't even talked about the single most important factor of all, valuation. This is why all these Harvard MBAs are morons. I love how everyone worries about all this other stuff that they worry about and not the one thing that matters the most. It's simple. When you pay more for something, your future return is less. When you pay less for something, your future return is more. That's it. The rest of it is just garbage. Every truly great investor says the same thing. I don't care what the Fed is going to do with interest rates. I don't care what's happening to the economy. My only question is, can I buy a great business at a great price? And when you buy the S&P 500, you're essentially buying the US economy. If you're buying individual stocks, there are still buys out there that are undervalued. It doesn't mean they're not going to go lower if the market has a major fall. They will probably go lower. You have to be ready and willing to be able to buy more as they fall. If you can't do that, you should not be investing in individual stocks. All right, guys, let's talk about why I don't freak out when the market does its thing. Even if there's a bubble, even if it bursts, even if stocks drop 20% tomorrow and 70% over the next 2 years, here's the simple truth. I don't invest based on emotions. That's not investing, that's speculating. I invest based on principles. So while everyone else is out there chasing hype or getting worried about the bubble popping, I stay calm because I focus on just one thing, the difference between price and value. That's it. I can only control when I buy. The stock market doesn't care what price I paid for a stock. Warren Buffett has said this 1,000 times. That's the game. If a great company drops in price and the underlying business hasn't changed, guess what? That's a buying opportunity. That's not a reason to panic. This is exactly why principle-driven investing matters so much. But you've got to remember, news follows the stock price. So as stocks fall, all the negative news will come pouring out to tell you why those stocks are terrible, why a specific company is doomed, and so on. And some of it might even be true, but for good fundamental businesses, it won't be true. This is exactly why principle-driven investing matters. It keeps you from falling into these dangerous emotional traps that crush most new investors. And that includes myself back in the day. The market is just an auction. It's a bunch of people yelling prices back and forth all day long. But just because a stock's price moves up or down doesn't mean the intrinsic value of the business has changed one bit. Guys, speaking of auctions, I have a great story for you. I own a lot of real estate, and I love going to real estate auctions. But you know what I do that's different? At a real estate auction, their goal is to slowly bring the price up. They might get on stage and say, we're starting the bid on this property at $2 million. Now, if I've gone to my guys and I've determined that I'm willing to pay up to $4 million, they'll say, do we hear 2 million? You know what I do? I yell 3.75 million right off the bat. And it always gets this reaction of, what the hell did this guy just do? Why do I do it? I want to scare everybody else into jumping up so high that they get uncomfortable. That's the difference here. Everybody else in the market reacts to what's going on with the price in the auction. You should not. I do it as a strategic way to scare people. You know, if NVIDIA is trading at $180 today, and tomorrow somebody came to you and said they wanted $300, you'd be like, no way, I don't want to pay you that. But instead, what happens is it goes to 180. Before you know it, you're at $300, and you're mentally justifying $300 as a reasonable price. It's no different. That's why I go to auctions and immediately blow it out with the highest price I'm willing to pay. And I guarantee you, it saves somebody their money because I never get the property. That's not my goal. My goal is to sit there and stop the insane, irrational creep up in price. And that's what I want to do with stocks. I stick to this process that works for me. I don't care if a stock is red or green today, red or green tomorrow, or red or green yesterday. I'm not here to trade. I'm here to buy great businesses at great prices that will build my wealth over the long run. Unfortunately, that takes discipline, patience, and a rock-solid strategy. The very fact that you're still watching this video tells me that you probably have that discipline and patience. Now, here are the 5 core principles I live by, and so does everyone in the Everything Money community. Number 1, we're investors, not speculators. Number 2, every investment is simply the present value of all the future cash flows you'll ever receive. So when you buy something, your return is based on everything you earn from that point into the future. Number 3, if we don't understand it, we don't invest in it. Number 4, in the short run, the stock market is a voting machine, but in the long run, it's a weighing machine. Number 5, the most important one, a great story becomes a bad investment if you pay the wrong price. Now, guys, I don't expect you to memorize all of these today. So I made a free, simple PDF that breaks it all down in plain English. There's no fluff, no confusing Wall Street lingo, just the exact principles I use to stay calm, avoid mistakes, and make better decisions. This is your cheat sheet. When the market is swinging wildly and emotions are running high, you can pull this up and remind yourself, I'm here for value, not for noise. So click the link in the description below, grab the PDF, and start reading it today. Do what I do. I read it every single day. It's my daily reminder. I'm essentially brainwashing myself into this belief system. It's simple, it works, and it'll help you invest like everyone thinks the pros invest, even if you're just getting started. So guys, there's going to be an opportunity at some point in the future to buy stocks at absolutely amazing prices. And guess what? We will be making videos someday where people are saying, Paul, you've been saying stocks have been cheap for a while. It will happen. And I want you to be ready when it does. So click the video link in the description. I will see you there. Thank you for your time.